for naked puts or for covered calls, I can just look at that view of weekly picks of the day, but I prefer here to look at the search myself so I can see the different ones, and as I mentioned, it had a wide bid-ask spread on the position. 30, 40 cent bid, 270 ask. Oh, that expired today. Might want to go further out in time. But I don't see CHU in here as the results, and that's okay. Let's just take a look at it up individually on the chain itself, okay? So the picks of the day are a great place to start if you're looking for potential trades, covered calls, or naked puts. I also use the weekly bull put default in the search as a pick of the day for bull put credit spreads, which had performed well up until, of course, the last 25 days or so. But it's still profitable if you traded it for the first quarter of 2018 or for the last year. Let's take CHU and let's look at the chain. And okay, so these are the standard maze that we're talking about, JD. And the stock is at 1388. Now, what you might be saying, and I see what you're saying, but we're basing the return off the midpoint. Now, let me just go to a call chain first, JD. That would help us out a lot more, wouldn't it? Let's just take a look at the call chain where we show the downside protection at midpoint percent if assigned. This one is a much more reasonable bid-ask spread. It's got a bid of 85 and an ask of $1. So I could probably get that midpoint, 92, 93 cents. Black-Scholes is at 94, so it's just a little bit below there. But at the midpoint of 92 or 93 cents, we're still looking at an assigned return of about 0.3%. Okay, and that doesn't sound too great for me for a 21-day trade, I agree. But it's not a loss, and you still have a 6.6% downside protection, meaning the stock can fall 6% before you're technically losing money on the position. If you're bullish, okay, on the position, the out of the money would give you a good return, probably more along the lines, personally, JD, of what I would look for and what you would look for a 20-day trade of about 2.7% with about a 1.8% return if unchanged. But of course, that's the only downside protection we have, 25 cents. So you'd have to be pretty bullish on this because what we've seen in the past couple of months, if the stock falls, we only have protection of 25 cents with this covered call. Okay. Now, you said that you ran a search, JD, and it came up. And you said that it would look like a loss. Well, it might look like a loss if you get the bid, but we're basing the returns on the midpoint. This one here is a reasonable midpoint price, 92, 93 cents, which would still give us a little bit of profit. But I don't think this is a good return for a 21-day trade. I'm looking more for 1.8, maybe 2% return for a 20-day trade, even on a $13, $14 stock. Are there good ones out there that maybe have a reasonable bid-ask spread along with other criteria that we'd want to see? Absolutely. Let's do a quick search using the covered call tool. I'm going to look for stocks in the $12 to, let's say, $16 range. We're just going to look for standard May expiration. I'm going to want a return, JD, of about 1.5%. We'll go that route here for the 30-day trade. And we're going to put in some other basic criteria that we want to see stocks in an uptrend and more. Okay, so let's take a look here. Let's go back to the search for covered calls. And I know my basics of what I want. We're using CHU as an example. We want to compare it to some other positions. Let's go ahead and clear the filters. Empty everything out of our parameter field down below. I'm going to just select May. I'm going to want a downside protection as well, probably of at least 2 or 3%. I'm going to start it at 2.5, meaning I'm collecting at least 2.5% premium for a 21-day trade, or we could look at it as the stock can fall 2.5% before we start losing money on the covered call position. And we want a minimum return of at least 1.5% or higher. I'm not going to worry about the in the money, out of the money range right now. We're just going to look at all positions, but I might change that later so we can isolate the in the money on our stock fields. I want to see something that traded at least one contract today. I'm going to look for a basic open interest of at least 10 contracts. Now I'm going to keep it simple. I could put in things for delta, bid-ask spread. Let's limit that actually. So on either screen I can limit by the percent bid-ask spread, where the bid-ask spread monetary value is less than a certain percentage of the bid price, I'm going to start off at 50%. Might lower that as well. You can do it monetarily. I prefer to do it by percentage. Now, I'm doing a covered call. We had some other criteria, didn't we? We only want stocks between $12 and $16 per share to make it sort of close to what we were looking at with CHU. I want to look for a stock that's shown positive earnings over the last year, reflecting good management, and I'm also going to avoid stocks between now and expiration. In addition to that, I'm not going to worry about market cap, dividend yield, PE ratio. I am going to go into the technicals, however. I'm going to look for stock that has a good average stock volume. Let's go with a suggestion here, at least 500,000 shares per day. This field is measured in thousands. Anytime I hover over a criteria, I can see the definition, so I'm going to put in 500. And I'm going to look for a stock that's trading above its 20-day or 50-day moving average. We're going 21 days out, so I want it to be above the 20-day moving average. I could put in other things for volatility, RSI, Bollinger Band, MACD. I'm not going to. We're going to keep it simple. What am I looking for? Any covered call with a May expiration, 21 days out. Minimum downside protection of 2.5%. Minimum return if I'm assigned of 1.5. Some liquidity on the option and a reasonable bid-ask spread to start. We can tighten that even more. I want some reasonable volume on the stock. I want a stock in an uptrend. I want a stock that's shown positive earnings, and I want a stock that doesn't have earnings between now and expiration. And to get close to comparables against CHU, we're going to go ahead and go between $12 and $16 on the position for the underlying security. Not a lot of criteria. Let's go ahead and submit the results. There's only 4. CHU is not in there. Why? Because the return was only 0.3% at midpoint. If I lowered this down, I'd have to lower the downside as well. That actually fit our goals, but let's put this 0.2 for percent return if assigned. Get some more results here. 14. CHU is not in there. Why? Because it's probably not in an uptrend, and it probably might have earnings between now and expiration, which I kind of want to avoid in a covered call. But you've got other positions around the same price. Finisar that match that criteria, 3.3% downside protection, 5.4% return if assigned, but it's out of the money. Okay, if I want it to be safer, I might go in the money for that lower return. There's some GE positions there, not recommendations. Navient, the in the money. Here's the 1337, 12.5 strike. Okay, bid of 95, but the midpoint would give you a 7% downside protection and a 1.3% return. Okay, much more than you saw with CHU. So I understand what you're saying, JD, is that you saw a result that looked like it was going to be a loss. Okay, and that was based on the bid point premium. Okay, I'm sorry, the return is based on the midpoint, not on the other position. Okay, all right. So that's what I'm looking for. You can email me later, or if you want to later in the webinar, send me the criteria that you were using. We can take a look at it. But you're right. I'll admit it. When we looked at the chain, which I don't have up anymore, let me just go to the chain real quick here from Finisar, but we'll change it to CHU. That May, based on the bid price, was not profitable. Stock's at 1388. You see a bid price of 1385. Okay, but at midpoint, excuse me, this is a close midpoint, only 15 cents off, so I'd assume that you could get 92 or 93 cents. It would give you a positive return. But I don't think that matches what we're looking for. We might want a little bit more. You'd have to gauge your expectations. While we're here, let's see why China Unicom did not match our criteria. Earnings per share growth, definitely above 0, what we were looking for. Next earnings, 8/16, it's unconfirmed, so we're probably good there. The other filter here, it is above its 20-day moving average, so there it is. I filtered it out by volume. CHU would have appeared when I lowered the result down to 0.2% return if assigned, but remember I had that 500,000 average volume. Over the last 90 days, the average volume for CHU is only 352,063. So real quick, let's see if we can get it in there. Back to the technicals, 300. We know all that's good. Hopefully we had some volume today. And I still didn't get it to appear. Downside protection. So it might not have the open interest or the volume we were looking for. Oh, yeah, no current volume. That did it. Okay, so now if I take that out there as well. All right, so this wasn't related to JD's question. Page 2. This really wasn't. There it is. Okay. But again, it's showing that 0.3% return if I move over this way, 0.3% there. And again, that's based on the midpoint, not on the bid. Second suggestion, JD, for you. Now that you know that we're basing it on midpoint, the downside protection, the percent return if assigned, and the percent if unchanged, what I'd suggest is going to choose columns on your covered call screen. This will allow you to pick and choose, and you can do this, of course, for any strategy, what data columns you wish to view. So what I want to do is go ahead here, and we already have the option bid selected. There's volume and open interest you can select as well. Oh, sorry folks, but I want to go ahead down to the bottom here, select option ask, bid ask spread, and percent bid ask spread. You might just want to use the bid ask spread, but that's up to you. Now before I submit it, I want to change the column order. So what I want to do here is on my column view, in my search, I'm going to move the ask price next to the bid, put the bid ask spread right there, and the percent bid ask spread. Okay, so now let's go back, close the window. It'll refresh the page for us. There we go. It'll take me to the first page most likely. Oh no, it left us here. That's good. So now what do I have on my view, JD? I've got the bid, I've got the ask, I've got the bid ask spread and the percentage bid ask spread. All these, of course, are below 50. Some of these are very low. And now I can see that, yes, if I sold at bid, it'd be a loss. But at midpoint, where the return calculations are based, it would be a small profit. We know that that's probably not going to match my goals. Put this back up to 1.5. And we'll be back to those 5 or 6 results that I wanted to look for May that match my criteria. A couple of these do have a reasonably wide bid-ask spread, but many of them only 10%, 50 to 55, perfect. 4.5, 1.7. Okay, so these are all still reasonable, good returns, 1 month out trade, low cost, some in the money, some out of the money, of course, as well, but it matches our criteria. All right. Okay, so we got a lot of questions still coming in from Randy, of course. That's the last one. I'm just scrolling down real quick. Okay, there's a comment there. All right, good. So we're all good there. And of course, then you can save this search so you don't have to put the criteria back in at any time. All right, got about 9 questions that have come in. I'm going to take them in order as they came in. I mentioned Randy. He was the second to last one that commented, that sent in a question. So we'll get to everyone's coming up. I'm going to switch gears now. Okay, Mark asks, here's a question. Is there a safe way to capture the modest ups and downs over a week in the current market, yet be safe from more major moves? I can't figure out any means to do without being glued to a market screen. And Mark, that is the case. I'm sure Sam doesn't mind. He sent me an email yesterday. Was it Sam? It was either yesterday or the day before. And we had this question come up last week about what Sam kind of does. He comments on the Friday sessions. He talks about, we already commented, the puts on Twitter, the gains, and so forth, okay? Now, to answer your question first, Mark, what strategy is going to allow you to take advantage of swings one direction or the other? Well, that's going to end up being some type of straddle or strangle. And I prefer strangle. But you can do in-the-money strangles, you can do out-of-the-money strangles, and more. Let's go out 1 week on SPY. And I'm going to do the out-of-the-money for now. And let's say, it's going to be expensive in this case, but let's say a 268 call. 125, 127. Oops, not the 268. Let's go 265, about the same price. I clicked it in twice, so don't worry about that. Let me take out this 268 put. Okay, so this is an out-of-the-money strangle. And let me just take it as it is, Mark. This doesn't look too good. You know, the upper break even, it would cost us a total of 244 to get into the position. So my upper break even, you know, in the next 4 days is going to be somewhere up around 267.44. Oh, I see why. Okay, let's go to May 4th there. Okay, there we go. So 244.50 to get into both. You know, max risk is about 100% of what you invest. Okay, so that's the key. What I'm showing you is that in this way, as the stock moves up and the stock moves down, you are going to be delta opposed here in the center. Okay, this is a structure I might start off with, but is it guaranteed that I'm going to make a profit? No. If I'm not looking at the screen or don't have trigger set, am I going to be able to get gains in one or the other necessarily? Maybe not, because I could see a drop down to 264, might be able to take out this 265 put for a profit, leave the 268 called and do something else in management and so forth. Okay, so what you're asking of, this is the structure. It's not a pretty structure, I know, because we're not looking at really the full graph here. But you want something that's going to move, and you could potentially see a gain one direction or the other. You could pick a direction and start off with a call, and if SPY goes up on Monday, take advantage of that, but when you think it's peaked, buy a put now to take advantage of the downside, or have them both open at the same time. But a strangle or a straddle, the V or the U profit and loss chart are what's going to give you gains if the stock swings up or the stock swings down. I don't necessarily want to sell, okay, because your second part of your question was, and it can take advantage of a large unexpected move. Well, if you do the short version, trying to collect the premium, now sure, you'll have an upper and lower break even that might be fairly reasonable. This is a 1 week out trade, of course, to May 4th, keep in mind. Let's see, you've got a wide upper and lower break even, but if this drops down to 258, what have you got? You've got a short put at 265. You took in 254 premium. So right at about 260, 255 is your break even. It drops down to 258. You've got to pay a large amount of money, $7, to close this put at risk being assigned. So if it stays within this range, that's good. But it's going to be going between 270 and 263. It's going to probably drop down to 258, maybe in the next 7 days or more. We don't know. It could go up to 280. Not likely with the way the market's been, but it could go up to 270, 275 very easily in the next 5 or 6 days. So the key here is that I won't sell in this case. When I'm thinking the market's going to bounce, I want to be buying. And now, though it's expensive because the volatility is increased, right? But at the same time, I want a structure that's going to give me this. Anytime you sell against it, you say, well, what about a double diagonal where now I can sell the, it's going to look ridiculous, the 3-day out Aprils, I'm sorry, the 3-day outs, and now I can sell, let's say, a 267.50 and a 266.50 or 266, you know, selling the out-of-the-money call and the out-of-the-money put. So as long as it stays within a certain range over the first 3 days, see, that doesn't even give us what we want, right? That's not the answer. Anytime you sell, you're going to be obligated to do one thing or the other. And that's going to shift it to where you won't take advantage of a sudden move one direction or the other, or a massive move in one direction if you play it the wrong way. Everyone wants to generate premium, I understand. We want to pay for it. But to me, to answer your question, Mark, to take advantage of these swings, we want to go ahead and be buying the positions, I feel, and managing them in that fashion. I know not everyone agrees with me. We had a conversation last week, good customer, good friend, well, I don't want to say friend, but a good customer said, is now the time for iron butterflies? And he was asking that on Friday of last week. So let's go to just a 1-month chart here for SPY. And of course, we see that on Monday, Friday the 20th, we were about the same price we are now. So maybe a 266 butterfly would have worked. Okay, if you did a weekly butterfly, at 266, but you would have had a heck of a day here on Wednesday or Tuesday. That's Tuesday the 24th. You would have had a heck of a day there and on Wednesday, because the butterfly at the 266 strike probably would have only given you $2 a premium for a 1 week out trade. The butterfly, remember, is the reverse. But you've got these outer wings here, okay? So you might have gotten $2, meaning your break even's at 264. You were below that on these 2 days. You were in the loss area. Now, it did come back up, but how long would you have stayed in it at the loss on a 1 week trade? Because you can't afford to take a 50, 60, or 70% loss on one of those butterflies, because that might wipe out 10 or 12 previous trades, put you right back to square one. Okay? All right, so that's kind of my thoughts here. Let me just pause on that for a moment. Let me scroll down through our lists here. Okay, let's see. All right, so there's some more questions. Believe me, I'm going to get to everyone's questions. I'm just scrolling down now. Sam says he does have a straddle for SQ earnings. He'll think he'll have good earnings and the stock might move one direction or the other, but he's going to manage it based on if he can get a profit beforehand. Sometimes that's what you can do with the straddles or strangles as well. Yeah, debit straddle, debit strangle. I call them a long straddle or a long strangle, buying them instead of selling them. Okay, and so that's what we look for. But the key here also is the fact that, going back, excuse me, Mark, you had 3 elements to your question. Whoops, don't want it. Don't want it. How can you take advantage of the movements in one direction or the other? And you might want to go more than 1 week out. I just use this as an example so you can take advantage of the time. Give the stock more time to move and be able to profit as well for a longer period without overbuying. I know this is a cheap cost, but you also want to make it worthwhile. But your 3 tiers were make money, taking advantage of you're expecting the market to swing almost on a daily basis. To me, it's the U or the V of the long straddle or the long strangle, legging into them. Even perhaps we'll get to that in a moment. Could you sell against this? Yeah, if you pick timing, but that doesn't satisfy your needs of not watching the market all day. I'll get to that in a second as well. Then, does it help if there's a sudden unexpected move? Absolutely. You haven't pinched off the upper gain or the lower gain. You haven't capped it off by selling a call or selling a put. I know we want to generate premium, but in this case, this is what you want to do. But not risk too much. Okay, so now what you have to do is make sure these plays that you're making, whether it's on SPY, whether it's on an individual stock, you want to make sure that your debit into the position probably doesn't represent more than 2 to 3% of your total portfolio value. And I know that sounds low, but what if we enter a lull? What if SPY just stagnates here at 266, 267 over the next 3 days? These are just going to drop to zero. The 268 call is going to lose all that time value. It's going to be worth 10, 15, 20 cents by Thursday. This option 265 put, out of the money, same thing. Okay, so that can happen if this volatility sort of ebbs, sort of settles. We don't see the moves you're expecting, so you can't let this be more than really 2 to 3% of your total portfolio in each position. Okay, and I wouldn't do many positions to where these straddles or strangles represent 15 to 20% of your portfolio, because if the market stagnates, they'll all stagnate unless you open 1 or 2 that had an earnings coming up, in which case they'd be very expensive because the implied volatility would be higher as well. Now, I kept mentioning that I'll cover that in a minute. Sam, I apologize. I am just going to show the position that you sent to me the other day. Oh, sorry, folks. Oh, yeah, there we go. Go back to the slides real quick. This is an email that Sam sent to me on Thursday, I believe. Okay, I apologize for not remembering the day right out on the top of my head. But to answer the other part of your question about not looking at the thing, this is a daily chart. And you see here, you know, Sam got into puts at 37 cents and he closed them at 79. So from here to here, from probably about 9:45 to about 10:15. Okay, so he's watching for a trend. Okay, and then when he sees it settle, he got into the calls here, paid 49 cents right around 1 o'clock, got out of the calls here at 78, and then he bought puts again for 69 cents. And this is on AT&T, by the way. Okay, so this is one of the things that where Sam sends us these trades, and he talks about the Twitter calls and puts and everything, and he's doing really well. He says he's selling rallies. He's commenting as we're going. He says he's selling the rallies because SPY is below the 10-20 EMA, and sometime is below the 50-day EMA will mean sell. Okay, that's one indication there. He also said he's in SPY almost every day. Buy puts, roll it lower, do not buy a call, and uses Fibonacci and retracement as well. But here's the catch, and it's great for what Sam does, and it's great for what he's doing, and he's got a great return. But 1, 2, 3, 4, 5 transactions from, let's call it 9:45 into about the end of the day. That's not bad, okay? But he's watching the market consistently, and that didn't solve your needs, okay? You asked what strategy gives you the advantage of taking advantage of the moves in the market that we're seeing without having to watch the screens, with being able to take advantage of a huge swing, but at the same time, not having to watch the market. This doesn't solve what you want to do. It works well, and it is working well for Sam and the emails he's been sending me, but again, it is required. It is based on watching it consistently. Okay, there's having a good eye on the market and having your good stops in place as well. Okay, so back to my point there is that maybe a 2-week out or 3-week out strangle, or maybe just buying a call or put with a low portion of your portfolio and then legging back and forth in the position might work for you as well. But you probably have to set triggers because you're going to have to catch them quickly. But yes, debit strangles, and again, let me go to long strangle here for a moment. When you go onto your account mark, a long straddle actually. There we go. Just want to go to the main long straddle homepage. There it is. Take a look at this video if you haven't yet. Ernie's talking about using the straddles for earning swings. The structure he kind of looks for. It's not the full presentation, it's the first part of 3. But I just want to mention that there so you can take a look at some of the ideas on straddles and strangles. But remember, don't risk too much of your portfolio, because if we hit a stagnating turn, that's when we might want to consider selling, but we got to catch it right, as Sam would mention, or we could end up holding a short put or a short call that we don't want to. Okay. All right, this is a question that comes in from Fernando. It's related to the married put techniques, the radioactive trades, which many of you have heard me say before that I use with about 45 to 55% of my portfolio. And our Canada Goose, keep looking at, I should have done this one, but let's go ahead and just look at the profit and loss chart. When I open a radioactive trade, as discussed in the blueprint, the structure I'm going to use is I'm going to buy shares of stock, and I'm looking to buy a put that's a minimum 150 days out in time, 1 or 2 strikes in the money. This gives me a controlled risk of under 7-8% is what I'm looking for on the position. And at the same time, yes, I'm paying extra into the position. Here I'd pay $36.58 for the stock. Instead of generating premium, I'm paying $6.35 for a put. Puts my cost at $42.93 or so. But in the worst case scenario, if this stock collapsed to $16 per share, I'm guaranteed to get $40 back. So instead of focusing on return first, as in a covered call where you can still take a lot of risk to the downside if the stock falls 10 or 15%, I'm going to focus on controlling risk first and then generating income with the 12 different adjustments. But Fernando's question is, what do you think about getting into the married put by, number 1, buy the put, then 2, enter the stock on a buy stop trigger. This way I can optimize the enter if direction is not up as soon as you get in. Obviously the risk amount is okay for me on the buy stop level. If the stock goes down, I trail down to buy the stop and so on until I get in. Well, if you were going to do it that way, I'd say buy the put, and if the stock goes down, don't worry about buying the stock, just leave the put open and profit on the put. But that's not what I would do. Of course, this kind of market does give us the opportunity to see a lot of different variations. But again, let's say that after the drop here, we saw a good pullback back in February. That was the February 5th through February 9th volatility. Let's say I saw a good price here, the stock trading at about $31 per share. So I buy the 33 put and then say, okay, let me go ahead and buy the stock. So the stock's at 31. Let me buy the stock if it drops down and I get a cheaper price. Well, now you're in a put. And as the stock is moving up, what's happening? Your put's declining and you don't own the stock. And you say, well, I would have put a trigger to buy it at 32. Well, now it doesn't have the risk you necessarily wanted. You wanted to buy the stock at 31 and the 33 put to have that 5 or 6% risk. If you set a 32 trigger, you get in at 32 and you've already bought the put at this price, you're now looking at a 9 to 11% risk. Okay? All right, so later on, here we go, 25 days later, you get an opportunity to buy back at about 31 where it was at the low. Maybe you wanted to get it at 30, but it hasn't triggered yet, Fernando. Okay, so now the stock goes up, and here we are at 36. All right, you've got a 33 put that's out of the money and losing value drastically. You're not countering it because you don't own the stock. This is a specific example. I know that. I picked it because I'm upset with myself that I wanted to do this married put when the stock was at 31 over here at the beginning of March, and again at the beginning of April. Instead, I did PHM, which is working out really well. But this would have been great to go from 33 up to where we are now, about 37. When you try to overthink the radioactive trade, and I'm not saying you're overthinking it, what I'm saying is that if you try to overthink the entry and you try to look for the best price, and why are you doing that? Well, to be honest with you, you're probably doing that because you opened a few married puts in February or in March, and the movement we've seen in the market over the last 2 months, let's just go 2 months, means that some days it looks like your married's put up and then others it's behind, then it's up, and you say, well, why can't I maximize this? Your timing has to be really good. If not, you miss the opportunity to profit and you end up holding a put that's losing value. In addition to what I just showed you on that Goose Island, GOOS married put, keep in mind too that even though 25 to 30 days in, the stock came back down to 31 or close to it, and I could have bought it then, where I could have bought it in February at the low, possibly. I've also just given up 30 cents, 40 cents of time decay on the put. Yes, it was 150 days out, but we just went through 30 days. So I lost time decay on that put without being able to do a real good income method because I didn't have the structure complete with the stock and the put combination. Okay. When I originally learned about radioactive trading, and many of you have seen me do a lot of videos on this, I started trading with options and with Ernie back in about 2001. Like most of you, I could only do covered calls, graduated towards naked puts, realized the benefit of standard collars, which I still do with a portion of my portfolio. That's back in about 2004, 2005. I've done calendar spreads, credit spreads, debit spreads, diagonals, straddles, strangles. I've never done an iron butterfly. I've never done a short strangle or short straddle, but I've done a short strangle inside of a married put combination. I regretted it. But I was the same as you. I knew options. I met Kurt in 2006. He was a member of Power Options. Kurt Frankenberg's the one who sort of created the radioactive trading concepts. But I was an options trader, and I said the same thing. Okay, why am I going to pay this much for the put? Why not just go 1 month out? Well, I proved that against myself. You go 1 month out, you end up paying more long term. But why buy the stock? I'm an options trader. I know that I can get into the stock at a better price. So I'll buy this October put that looks good rather than buy the stock at 36.58. Let me sell that 36.50 or that, let me use the 36 actually, but the 36 strike put for $1. Why pay the money out to buy the stock? Why not leverage it by trying to get into the stock at a better price and get paid to do it? Well, okay, but now I'm in an entirely different structure. I'm actually in a bearish trade on a stock I was just researching to be bullish on. Okay, I wanted a bullish stock. That's what I was researching when I set up the married put. But now I'm saying, well, let me take out the stock that gave me the positive delta, try to get in at a cheaper price. Now I've got 2 ways to lose, and the biggest loss is in the direction of all the research and analysis I just did. Yes, I opened 6 positions this way when I first learned about radioactive trading instead. What happened? 5 of the 6 moved up, 5 or 6% in the first 30 days as I would have expected with a married put. I lost on those 5 calendar puts, made on one of the married puts. I would have had a 4% profit on all of the positions that I just opened it as a married put at the time I found them. So I don't open radioactive trades as a calendar put spread trying to get in at a cheaper price and time the position. I don't leg into the married put because I found a stock that I'm neutral to bullish on, that I feel has the opportunity, or the best structure to probably move up again 3 to 6% in the first 20 to 30 days. And the structure that gives me the best outcome is with the married put in that situation, not trying to do this calendar put to get in a cheaper price, not doing a deep in the money long strangle where I'm buying an in the money call and in the money put because now I'm delta opposed. Okay, the stock and the put combination gives me the best outlook. So that's what I look for. I don't leg in. I've tried it in the past. I've tried it different times in the past when I thought market conditions were right. I found in my personal portfolio it works better to open the stock and the put together at once rather than leg into each position to look for a better price and get yourself stuck in that situation, okay? Because if you mistime it, you're losing on the put, you're not gaining on the stock to counter it, okay? Okay, so give me 1 second here. I'm just scrolling down here, okay? This is a good question from Will. There's a couple more. Let's see here. Just going through. I know there's other questions, but I'm going through to see the commentary that's going through on with this discussion. Oh, Sam does mention, it said if you own puts and if the stock goes up, he'll sell the put in the money to make a neutral trade. Bull put on SPY last week was worthless in that fashion as well. Okay, and it also sort of creates bull put. And okay, Fernando says there. There we go. Okay, so Will's question is related to this. I've got many other questions. We're going to get to them all. But Will's related this, and it's related back to the married put structure. And I chose Goose. Those of you that might be Fusion subscribers, you can tell I'm probably going to look to open a Goose married put next week just because I've kept eyeing it. And I'm a little upset, but not really. It's still a good trade, I think. I'm probably going to go into it. That or Michael Kors, and the PHM is doing really well. Anyway, Will's comment is to set up a married put. Is there any advantage to open only when the IV percentile is relatively lower than 30%, meaning that only looking for married puts where the put implied volatility is in the lower 30th percentile of its entire IV range since the option was released on the market? Will's thinking is the correct thinking, is thinking that it's cheaper to set up and the stock is probably in a bullish trend. Both might be correct, Will, but the other advantage of doing that is that you don't get stuck with a volatility crush out of nowhere. I typically, it's not here on the main screen on the default search, Will, but I will typically use an IV range, percent implied volatility range of less than 65 for my married put positions. Okay, Canada Goose is in there. Why? A long time ago, I opened a married put position. I'll just go back to Goose Island. And let's take a look here. Let's say the implied volatility was at 0.65. Here it's at 0.446. Okay? But let's say it's at 0.65. So it actually probably, let me go 1 day away. Let's go 1 day away and see what the theoretical value of that put would be. It'd be 848. Okay? So if I paid 848 for this put, I'd probably be out of bounds on my risk anyway. That's one of the other features. If the implied volatility is too high, the risk would be too high. 11.2%, I'm not doing it. Let's cut it down by $1. Okay, let's put it at 740. Let's put it at 750. That should give us around 9% risk, right? 9.3. Okay. A long time ago, I had a married put on El Paso Pipeline. I learned my lesson, Will, and I think you're absolutely right in this. I think 30% might be too low. You might want to test it out a little bit over time using ranges under 50%, under 40%, and see how it pans out. But the basic structure was I bought stock at 30. It was maybe 28, but let's say 30. And I bought a 32.5 put for around $6. So it was expensive. No, it wasn't. It was $5. So it was expensive. Okay, but my risk was only $250. What I didn't realize at the time is that the 3250 put I bought, it was 3250 here, the 3250 put I bought for $5 was at 97% IV range. All right, so it's sitting here at $5. I've got 35 invested. I've only got a $250 risk on a $35 investment. Not bad. It was still under 7%. And the reason why is that El Paso Pipeline was doing something with trying to get land lease somewhere in Central America. I can't remember where. I'm sorry, but it was somewhere in Central or just northern South America. And so they're having this discussion with this land lease. And a month into the trade, the stock's still trading at 30, and the lease failed. So what happens? Well, the implied volatility, which let's say was around 0.60 or so and led to the cost of $5, instantaneously dropped to 0.28. This only took $1 hit on the stock, by the way, but this dropped from 0.6 to 0.28. That 3250 put, with the stock only moving $1, dropped from $5 down to $3.75. That doesn't seem like a lot. But now it's very hard to manipulate the put with the income methods that relate to the put, income method number 3, 4, 9, 12, and others, because I've lost $1.25 on the put while the stock lost $1. I did get out of that position with an eventual profit, but it took me 4 months to make up the difference I lost on the implied volatility crush. The stock did recover up to $32, $33, so it worked out okay. But from that moment on, I decided I'm never entering a married put. I saw what had happened. Never entering a married put if that percent IV range is above 60 or 65%. I think 30% might be too low, Will, but I'd encourage you to trade it, test it out, see what's going on there, see some examples, okay? All right, let's move on from this, and I'll check some of the comments in a moment, but I want to get to those of you that have been patient, starting with Rose. Rose says, how to buy Amazon stocks and buy an option to protect it. Is it more profitable to only use options to trade? More profitable is a tough question, Rose, okay? If the stock does what you want, buying a call rather than buying Amazon outright could be more profitable if there's a significant enough move. If, again, the implied volatility is not too high and you're not paying into extensive implied volatility. I had mentioned before that, yes, I do the married put, again, with 45 to 55% of my portfolio. I do other strategies such as diagonal calendar spreads, calendar call or calendar put based on my market preference, bull put credit spreads, other credit spreads, and occasionally buying calls and puts, the straddles around earnings. But when I do a married put based on my account size, my settings are here between $9 and $85. What does that mean? It means you're never going to see me open a married put on Amazon because my account dictates I cannot buy it. Okay, it's expensive. So if I was to structure a trade on Amazon for a married put, I think they have October's. Let's take a look here. Yes, good, perfect. You see, I mean, it'd be $1,572 per share. I'd have to buy 100 shares, one put alone, slightly in the money, probably my target here. Yep, that would be my target, $1,590, 6.5% risk. That's $127 alone. I'm not even buying $127 stocks, Rose. This doesn't answer your question, I know, but my net debit would be $1,700 per share. I'm only risking 6.5%. That's great. And it gives me a nice structure, positive, oh, sorry. Why does it do that every other time? Positive delta structure where I can have a good profit and I'm only risking 6.4% on $170,000 for 100 shares. Okay, so in this case, I'm not doing that. What I'm more akin to do in this situation, if it matches my portfolio risk size, is rather than do the combination of the stock in that put, what did I say, was it 1590? I might buy the 1590 call. But again, one contract is more than I allow myself to pay for underlying stock for a married put position. So I'm not doing this either. Can I buy a cheaper one further out of the money? Yes, but now the stock's got to move so far for me to get a profit. Why am I still going 5 months out in time? Because I want to give the stock time to move in my desired direction. Could you profit with buying a 7-day, 14-day, or 21-day out call? Possibly, but it's going to come down to what is the cost. We'll just go to 21 days out for standard May 18. 1580 is $36. That's not too bad, but we need the stock to be trading at 1610. Worst case scenario, right? The debit you'd pay, let's call it 37. We get a nice fill. So I'd actually need this to be at 1617 in order to make a profit in 21 days in the worst case scenario. If it moves up to 1570, 1580 prior to that, this call might be worth $43 or $44. I make $5 off of a $37 investment. That's not too bad. But if it drops next week, goes down to 1560, this is probably going to drop down to $30, $29. Now I need it to come back faster and more. Okay, so if you're long-term bullish on Amazon, you think it's a good play, I would go out 3-4 months and set up the structure that looks like the risk you'd want to see on a married put, and then use that strike as the call. But don't let that call purchase represent more than 4 or 5% of your total portfolio value. Okay? Now, there are other ways to do this. Chuck has a great point, and I was getting to that. It says, what about buying a bear put debit spread for protection? Okay, so you could enter a bear put debit, but that's going to increase the cost. You could do it short term if you bought far out, Chuck. That's absolutely right. What you may also want to consider in this case is something a little different. If you are long-term bullish, now I could go out this far, but I could maybe buy the 1590 call we mentioned and maybe sell 1620. This is a bull call debit spread, but I'm hedging the original cost of the position, that long call that I bought that's out of the money, by selling a call against it. Okay, so yes, I'm still paying $1,400 for this structure. I have a capped gain of $1,572 if it moves above 1620. This is 3 or 4 months out in time at the same time. But I've only invested $1,400. I have the right to buy shares of stock at $15.90. I have to deliver it at $16.20. Okay. John says a leap. Well, yeah, these are leaps, but they're already $1,500, $12,000 to buy in October. You go out to a leap that's in the money, you're going to be paying $17,000, $18,000, $20,000 for one contract. Is that worth it to your account size? Okay. So Chuck mentions the bear put debit to protect it. It's a reasonable idea, but it is adding another debit to the position. Okay, so you're adding to the cost, and if it stagnates between the two, it doesn't move up to the long call strike you were hoping for, but yeah, it would stay below the bear put debit that you did as well, so you'd get some of that back. Let me show you that structure too. But I honestly think that 3 to 4 months out, you might not go 5 months out depending on your outlook, but an at or slightly out of the money bull call debit spread still gives me the right to buy at $15.90, but I've hedged it with the $16.20. Now, if I wanted to own the stock, let's say it goes to $16.10, I wanted to own it and exercise my $15.90, that's great. Then you'd be in a covered call unless you bought to close the short call as well. Okay, so that's what the position you might run into in that scenario. Oh, sorry about that. There, yeah, so the debit spread, the bull call debit spread me one way to go to lower cost, and you don't own the stock, but you still might be taking advantage of gains, and you've hedged it a little bit. Chuck's idea, let's stay with the October 1590, slightly out of the money, $12,700 for one call on Amazon, and now he's thinking, not thinking, sorry Chuck, that's the wrong term. He's saying maybe even shorter term or at the same time, but we could go shorter term to May, and I could add to the cost by doing a bear put debit where I'm going to sell maybe an at or slightly in the money put. Let's sell the 1580 and buy the 1590. So I'm going to have an additional debit here of $2. Now, the trick with this, though, doing a bear put debit, selling the 1580 lower strike, buying the 1590 by itself is a bearish position. If the stock stays down, oops, Added it twice. My apologies. There we go. That's better. But here's the trick. The bear put debit would cut down the cost. I mean, it would add to the cost here, but it doesn't protect to the downside. You could still lose on the call. All right, so by itself, if I bought a call, a bear put debit doesn't hedge the long call. I could still lose the 12,248, close to the same amount as the call itself. I could play around with structure a little bit, use different strikes, for example, try to get a wider spread and maybe a different timing. I could go out 2 to 3 months instead of this short in. But remember, the gain that you make in the difference in strike prices minus the debit is the only value that you'll hedge with the long call. Right, so I use the 1580. If I go further down to the 1570, I'm getting lower price now, right, for the 1570. I'll have a higher debit, but I have a wider strikes. So this narrows the loss down to 11,000. But again, I think the bull call debit might be a better way to go than using the bear put debit to hedge. The other thing that I might approach, and that Rajiv just mentioned, in this scenario, a diagonal spread, which I mentioned. And in this case, what I would do here is I'd probably go a little bit deeper in the money. But I'm going to use a diagonal spread, Rose. So instead of buying the 1590 that's out, I might pay a lot of money and buy the 1560 call, October, possibly to June or July, maybe even August, 112 days out, good, almost 3.5, 4 months out. But now shorter term, I'll go to May 11th, it's only 14 days out, I like that number. I'm going to sell a call against it. Some might refer to this as the poor man's covered call. So I say in the next 14 days, I don't think Amazon's going to go above 1585. I've bought a call at 1560 far out, paid a pretty price for it. Remember, we're at like 140. Yeah, so I'm going to buy the 1560 call, but now I'm going to sell the 1585 call against it. It's diagonal calendar spread, and I can potentially sell month by month against this. So this case, I'm using an in the money. I'm selling near term against it, diagonal calendar call spread. It's a good approach and probably how I would play Amazon if I'm bullish on it short or near term. See, I don't have to hold this all the way to October, Rose. I can sell the 11th of May, 14 days out, and if that expires, the stock doesn't reach 1585, guess what? I can sell the 25th of May, 1590, 1595, generate another $27. So I'm cutting down the cost of that leap by selling the near-term calls against it. This does still put me in a position where I'm obligated to deliver shares of stock at this price, but I have the right to buy it at this price. By the way, yes, I would do this trade. I'm sorry. Yeah, I would absolutely do this trade. You always want to make sure that the debit you get, the debit you pay to enter the position, is less than the difference in strike prices. But keep in mind here too. Oh, shoot. Sorry, folks. Sorry about that. Keep in mind here too, you are risking 100% of what you invested in the position. If Amazon pulls back and drops down to 1540 or 1530, this call is going to drop in half. It'll go to $70. The out of the money call will go to $75, $70. You invested $11,517. This call does expire, but you only get $75 back. That's $4,000 loss off $11,000 investment, 33%, 44% loss, and it can go further. Leverage spread trade. Both the bull call debit spread and the calendar spread are leverage spread trades. They take that risk, okay? All right, so on this topic, before I get to the new ones, Chuck says, is it okay to buy a 2-year out leap when doing the diagonal spreads, or is it better to stay only 150 days out in time? No, it's perfectly fine. Whether I'm structuring a married put or looking for a call to buy for my diagonal call spreads, I go at least 150 days out to start. But in this case, if the January 2020 leap put or leap call still matches my cost basis for the position or my maximum risk in the married put without going too high over, even though it's 2 years out, I have no problem using a leap. One of the advantages of using the 2-year out leap in either scenario, the diagonal call spread or the married put, well, more for the married put, but if in the first 60 to 90 days, the stock's not doing what I expect, I can sell the 2020, even though the stock hasn't moved. It still retains so much of its time premium, and lower my cost by buying the 2019 or the February, move it closer in time. That would cut my cost basis down on the position, lower my break even. I'm not at profit yet, and I've shortened the time, but it gives me an extra management, Chuck. You're absolutely right. With a diagonal spread, it's more difficult to do that. You can do that, but it's more difficult because when I set up the diagonal spread, the cost I paid for the leap option or the far out option combined with the premium I'm collecting times the number of right cycles. So if I'm out 630 days and I'm selling 14 days out, that's my plan, 14 to 20 days out against it, I know I have a certain number of theoretical right cycles. So the premium I collect times the number of right cycles would definitely have to be greater than the cost of the initial option. So I'm in a diagonal spread and the stock's staying right here for the first 3 cycles. Well, I'm lowering the cost here, but now if I move that call in, Chuck, is one of the methods. Now I decide to sell to close my January 2020 and move it into January 2019. I've knocked off 12 to 20 right cycles. Did I make enough already to now going forward from, let's say, June to January, 230 days, that new right cycle number still achieves what I want? That's tricky. I have no problem going 2 years out in time with the leaps as long as the cost and the risk involved for a married put, for example, still matches your goals and your structure. If I like a stock and I'm looking at a 2019 January put for a married put combination or a calendar call, I'll look at the 2020. But even though it's 2 years out, even though it's 630 days, if that increased time value puts my risk at 15 or 16%, I'm not going to do it. If it's 11%, I will for a married put. But if it's 15 to 16%, I probably won't, because if I'm wrong and the stock drops 33% over the course of the first 2 months, then I'm looking at a position where I'm probably already close to a 12 to 14% loss, and I don't want that. Okay? I don't want to take that chance. If I have the 10% risk and it drops 33% from an unexpected event in those first few months, I'm probably at a 7 or 8% risk, which is in line with the worst case scenario I'm willing to take. Okay? Sam offers his opinion. He would not touch Amazon right now. There are plenty of other stocks in the market to trade. You could make same returns in ETFs or stocks. Okay. John says, is there a reason you prefer to sell 2 weeks out in time? Yes, it's based on my structure and my trading plan that I did with the bull. Sorry, folks. I accidentally clicked the stop recording button and I just clicked it again. So I don't know if we're going to have 2 parts of this presentation or just one, but I'll make sure to review it. But we did get all of Rose's conversation in there, guaranteed already in the first part of the recording. When I did I took them out, when I did the testing for bull put credit spreads, bear call credit spreads, same what Ernie did, exhaustive testing, different criteria, stocks, options, what it would do to get the best results over a 1-year or 3-year time period and more. What both Ernie and I found at different times, he did his credit spread testing years ago. I've done mine over the last year and then tested over a 5 and 10-year period, actually. What I found, John, is that for structures such as this, bull put credit spreads, in my own personal account with the diagonal spreads, I found that if I had done the same stocks, here's my bull put weekly defaults. You see, everything is 14 days out in time. And that's because with the exact same stock criteria that worked the best, if I change this to a lower net credit to do 7 days out, the same types of stocks that match the same criteria I'm looking for, MACD, Bollinger Bands, stock above the 52 moving average, and not between now and expiration, but match this other criteria with the exception of now I'm going 7 days out in time and got to lower the credit a little bit. The 7-day out or 5-day out trades, if you opened out on Monday for the credit spreads, debit spreads, and what I found with the calendar spreads, had a lower return over time than going 2 weeks out. And it's because of the effect with credit spreads, it's mainly because when I go 2 weeks out, I can get 24, 21, 45-cent net credits. And this same strike difference would maybe equal a 15-cent. Not not quite half. Still looks like an annualized return would be better, right? 15 cents as opposed to 24 if I can get it every 7 days. The problem is now the win-loss structure affects your returns, meaning that if I'm taking 15 cents or getting a smaller premium in the diagonal spread by going 5 days out, opening on Monday for the Friday, or going 7 days out on the position, you're getting a smaller premium. So the losses you do take wipe out 15 to 20 previous trades. Instead of, if I take a loss on a 5-point spread, I'm averaging, let's say, 23 cents or 24 cents, I take the 475 loss. Well, yeah, I've still wiped out about 15 trades. But going week by week, if it's only 15 cents and I took a 5-point loss, I've wiped out close to 35 to 40 trades. Now your win-loss ratio has to be in the 95, 96% of the time to be profitable. Whereas the testing I did, these trades were right 93, 94% of the time, but I'm getting a higher net credit. So one loss, usually around a 2 or 3 point spread, only wiped out 10 or 11 trades, and I was still in a better place there as well. Okay. All right, so Chuck, I'm going to have to, sorry, let me see this here. No, John. Well, John, let me answer it this way. John says, therefore, you only look at stocks with weekly options. For bull put credit spreads and for calendar spreads, yes, but there's a switch. On May 4th, the positions that match my criteria will be for the 18th of May expiration. I don't care if they offer weeklies or not. If they match my criteria at the top of my list for my bull puts, I'm opening the standard expiration. They don't have to have weekly options, but at that time, the standard expiration is 14 days away. Okay, so I don't isolate it only to stocks that offer weeklies. But yes, since I'm running the search today, I'm only seeing weeklies that expire on the 11th of May, 14 days away. Next week, I'll only see the ones that expire on the 18th, which is a standard expiration. I'll have a mix in there as well. All right. So I apologize if I pronounced this name wrong. Kokan, I need an option strategy to assist with the stock. I own that is falling in price. MU bought at 57, now 47.5. All right. First thing I'm going to tell you, Kokan, is that when you have the time later this weekend, I want you to go to powerop.com/webinars.asp. It's our public webinars page. And I'll just go there now. And under the options concepts, there's an old presentation, but it's still the same material I'd present today called Manage Your Broken Position. This webinar discusses the alternative methods for managing a stock position that has fallen in price, or if you had a covered call that moved against you, or you sold a put option and now got assigned, but the stock's well below your cost basis. Okay? So I want you to take a look at that position, manage your broken position. The first thing I would do on power options, so I plug MU up into the symbol, and I'm going to go to the stock repair. No guarantee we're going to find a repair, but what this tool allows you to do, $57 cost per share on MU with 100 shares, it's going to try to structure a ratio call spread to help you get back to break even faster. What does this table mean? So in the near term, because it's down almost 10 points, we don't see any near-term repairs for the May expiration, June expiration, but one comes up in July. And what it shows me here is a cost of $47.52. It's the current price, $58.34. And then it's showing me the strikes. A combination of a 47 and a 52.5 could generate 34 cents of net credit and lower my break-even down to 51.83. How? Well, click on Repair Details now, Kokan. What this repair shows me is I could buy one July 47 call at 480. Sell two. Well, if I had 100 shares, 1 to 2 ratio. If you had 200 shares, it would be 2 and selling 4. Okay? Well, I sell 2 at 52.5 call and get 257 or 514. So I'm only getting 34 cents of net credit. But my break even now is lowered to 51.83. How? Because I entered a ratio call spread where I essentially own a 47 call at a credit of 34 cents. Sure, yes, I sold 252.5s, But what happens if the stock's at 51.83? Well, you're still at a $5.17 loss on your stock, but that 47 call is worth $4.83. You keep the 34-cent net credit, and the 52.5 are still out of the money. So sell to close the call at $4.83, sell to close the stock at $51.83, keep the 34 cents, you've got $57. You're back to break even without needing the stock to go back up to 57. In the webinar, I mentioned that at this time, because the stock has dropped so much, the repairs aren't able to June or July. That's not bad. It still gets you back to break even faster, but July, again, is about 112 days out. One thing you might want to consider, I don't know how many shares you have and what your size is in your portfolio, Kokon, but what you might want to consider is buying, if I had 100 shares, buy another 100 shares at $47.52. This would put my cost basis on the stock now down to about, what, $52.25 roughly? Right, so I buy at $47.52. I've got another 100 shares at 57. You know, cost base about 104 divided by 2, yeah, so we're at $52.25. Then, now that I've doubled up the account, there's a repair for May, where I only need the stock to go up to $49.81. Another May one at $49.66. There's June ones where I'd only need the stock to go up to $49.42. What does it look like in the profit and loss, Kokon? What I would do now is, now that I have 200 shares, of course, well, it would work the same way, but I have 200 shares at $52.25 average cost basis after averaging down. I'd buy 2 47 calls at $3.25, sell 4 50 calls at $1.83. All right, so I'm getting $3.60 back, 40-cent net credit. Now what happens is, as the stock moves up, your 47 calls gaining, the 50s are still out of the money. You see your break-evens at $49.42. You don't need the stock to go back up to 47, but this is putting more money into bad. Only do this repair, the stock repair, if you think the stock's going to recover and move back up in price. What is the one thing to note about this? Whether you average down or not, it doesn't protect the downside further. You can still take larger losses. That's all described in the webinar, Kokon, so I would suggest it'll go through that more in depth, the pros and cons of averaging down before using the stock repair, other ideas to fix the position based on what you find in your cost basis. But again, go to free webinars. Under options concepts, manage your broken position. That'll give you a lot of different ideas there on how you can manage that broken position, for lack of a better term. It's a phrase I like to use, as well as go forward. Okay, hold on, everyone. Let's see here. All right. Okay, so that's a different question. I'm going through some of the comments here. Rose, in your example of the diagonal spread, you might have asked this before we move on, or in the ratio call spread we just looked at. Hold on one second, folks. Let me get back to the screen I wanted. There we go. Now, let's clean this up. All right. In either case, let's go back to here, analyze the trade for that May repair. Oh, that was why I had that up over there. All right, so Rose, in either case, in the diagonal spread, yes, that we looked at earlier, could be assigned early on the position if the stock moves above the short strike. You do have that obligation. Your broker would most likely exercise the long to deliver your short obligation. In this case of the stock repair, same scenario. But remember, if you just did a ratio spread by itself, if you sold 2 and bought 1, you have infinite risk to the upside. Your broker now will see this ratio repair, the stock repair, as just a covered call. You own 100 shares of stock and you've sold a 50 call and a bull call debit spread. You can structure it that way so that it doesn't look like you have a naked call, right? Because usually if you sell 2 and buy 1, one of those calls is naked. But when you own 100 shares of stock, one of these short calls is covered by the stock. The other is essentially part of just a bull call debit spread with 47.5, 50 strike. Now, can you be assigned? Absolutely. If MU decided to gap up to 52.5 before expiration, what's my position? I've got essentially a covered call with a 50 strike and a bull call debit with a 47 and a 50 strike. So I get assigned here. I close this out for the 3 points of profit, and I'm still in a covered call where this 100 shares could be assigned at that other 50 strike. All right, that might be okay because I'd be back at break even at 52. So let's say stock trading at 52. I'm back at break even early. I didn't need the stock to go back up to 57, but I do run the risk of being assigned on the position, which isn't necessarily a bad thing to get back to break even. But if you wanted to hold it long term, hoping it's going to recover, you could still get assigned as well with a stock repair. Okay. Sam comments that MU is undervalued. You could buy more at this level too. Growth rate is expected at 53%. So yeah, I'm not going to give that advice that it's one way or the other. I'm showing you how you can repair, of course, and you can take that and watch some of those other ideas going forward. All right, Randy's been very patient. So hello, Mike. I'm a Blueprint owner. Just getting back to trading. On Wednesday, I bought 100 shares of AMD. Let's clear out our custom spread here, build a new position on AMD to take a look. All right, so for Randy, let's clear all this out. AMD, 100 shares at 9755, and you went deep. Yeah, I think you maybe went too deep in the money here, but that's okay. Potentially 9.755. We'll just use 100, yeah. And then you bought the January 12. I think that's too deep in the money. Okay. January 19, the time's right. The 12, no. Oh, okay. I'm sorry. I thought, never mind. I thought you did it earlier. Okay, but you bought that at 298. So cost basis of 298 might have legged into this position. That's good. Very good. So I look foolish now. That's okay. Got a 5.8% risk on the position. Monetarily, only $74. Looks pretty good, but you are deep in the money. Stock's at 11.11. Okay, so your question is, if you have the time, could you plug that in and show me how to see possible ideas? Okay, well, the first thing to do, Randy, remember, is if you add the position to your portfolio, I'm just going to do it here from the custom spread, and I'm going to put it in the radioactive, even though it's not my trade. We'll plug it in there for you, Randy. Date doesn't matter, so we'll just put it in with our prices, okay? Now, AMD, your 9755 cost is now, sorry, folks. There we go. All right. Oh, come on, guys. Not you guys. There we go. PHM AMD. AMD is up 13.9% from your price. That's what I wanted to look at. Now, as I'm tracking any of these positions, Randy, what I'm going to do is use the More Information button, go to Position Actions, and then Position Analysis. This, of course, gives me a breakdown of that current position. There's your risk of only 5.8%. Liquidation value is not as high as I'd expect, but it's probably because we legged in the position, but that's okay. And then down below, we see the opportunities here. So there's some ideas for income method number 1. I'm probably going to the May, 21 days out. It's only 14 cents. But it is going to reduce my risk down to only 4.7%. You could roll the put in time. I don't think this matches your goals. You could bulletproof it now by selling to close your January put and buying to open a May 12 or a May 13, but now you're only 28 days in the trade. I don't think that's an income method that matches using income method number 3. 6 doesn't look good now either. Okay, so what's missing? Well, a couple things. That showed us opportunities based on the rules in the blueprint for income method number 1, income method number 3, which I don't think matches your goals, and income method number 6, which wasn't a good premium. Are there other adjustments that could be made? I mean, right now I'd be tempted to just sell the May 12 call or maybe wait till it goes higher. I could use income method number 3 but not come in as far. Okay, but that's dependent on your outlook. If I sold the January now and bought, see, I don't like it. I'll go to October. I don't want to go to July. It's only 84 days out. I want to be still at least 3 to 4 months out. So I'm going to October 12. We're not going to get much premium here. It's not bad, but see, you could sell this at 209. Yeah, you lose 90 cents, but this is only going to cost you 183. But again, you're only making about 26 cents. That takes the risk down to $48, and now you've got an October put, and now if I sell that 21-day out May 12 call for 15 cents, now that's the problem with these lower price stocks. You look at the percentage. We don't want to necessarily look at the price for premium. It'll drive you nuts. But again, we cut that now down to 2.8%, with still a profit of 8.3, and that's to May expiration. That's not bad, but you've shortened the time in the put. Now we have all these fancy numbers, we have all these 12 different income methods. Why aren't we talking about other ones? Depending on your outlook for the position, with a stock at 11.11, I'd want it to be higher, but I can tell you right now, an income method number 6 isn't going to be that good because there's not enough premium. All right, we saw that back on the page as one of the opportunities, but if I did a 6 now, I'd probably be selling the 12 and buying the 13. Well, you're only getting 10 cents of credit. It's a good plan, it's a good play depending on what your outlook is, but you're only getting 10 cents. You'd have to go further out to make that even make sense, and I'm talking July. That to me is too long for an income method. What about this magical 5, which we kind of just looked at? Well, it's not there. All right, so you need the short calls you're selling to be at the 12 strike. And when you do the income method number 5, that ratio call, you need to buy 1 and sell 2, just as we saw with the ratio repair. But you need to do it at a credit. I can't buy the 11 and sell the 12s and get a credit. I can't buy the 1150s and sell the 12s and get a credit. I can't even do the 12s and the 1250s really by getting a credit. So they're not appearing. Income method number 5 is not a good idea at this time, which means income method number 11 is also out as well. I'd be tempted here, without giving you any direct stock advice, but following the rules in the blueprint, I'd be tempted, if you are bullish, to wait for the stock to go up further towards 1150 or so, 1145, then see if there's an opportunity for a better premium on the 12 call for just an income method number 1, or maybe a 12-13 income method number 6 bear call position. You could roll into the October now to lower the risk a little bit, but you have to ask yourself now, is that the best approach for what your original goals were? Meaning that if you roll into October and take the risk down to that 4.8% line or 3.8% line from where it is now at 5.8, at 20 to 30 cents credit you'd get, does having the October put still match your goals for the time frame that you expect the stock to move up in price? Okay. If you're bearish, then you might want to consider a 12. If you fear or you feel AMD is going to pull back, then you could look at that as far as income method number 12 goes. But that's more of a directional play. I'm more focused here on looking at what's available now. The 1 is not too bad. Rolling it into October is not too bad, but I wouldn't roll into May. Yeah, and Sam says he was looking at bullets too as well. Okay, good. So those are my thoughts there on the married put here. I've got a question from Rajiv. Wait, there's another question. I'm sorry, Fernando, Rajiv, and I got another question from Chuck came in. Sorry, Fernando says, what is the best way to protect a gain? For example, $10,000 making on Euro USD spot change. With the dollars, I have bought the American stocks, but I don't want to lose this gain because of a variation. If you've got a gain in your stock that has a profit on it, I'm going to tell you just to buy a put against it to protect the loss, to bulletproof the trade. You've got a gain in the monetary value. If you buy a put there in that case, then you can lock in the profit with the put option, a guaranteed profit if the stock fell. You may even be able to talk to your broker about taking out the cash on that protected put position, that married put position that's bulletproof, what they call portfolio margining, and convert some of it over. Okay, but if I have a gain in the stock that's not protected right now, I'm going to add a put to the position. What do I mean? Let's say, well, this is at 11, it's a 13 gain. Let's say I actually got in AMD at 875. I don't even know if it's ever been at 875 before. But I own it at 875 and the stock's now at 11. So if I buy that's May. If I go out to, let's say, October, if I'm still bullish, but if I buy the 12 put at 184 or so at midpoint, right, because I had that much lower cost basis, see, now I'm a bulletproof trade. I have a stock that's gained 20% or so from 875 to 1111. I'm paying 142 of that to guarantee an exit at 12. I now have a bulletproof trade. I can't lose. Have I locked in the full $2.40 gain? No, but I've locked in about half, and I'm okay with that. I've got a guaranteed profit on the position, locked in, guaranteed. Now, I don't know about yours, Fernando, because the whole international thing, but some brokers here may allow me to do portfolio margin, meaning that since this position is protected and guaranteed a profit of 142, I can borrow or take money off of this since it's already a no-risk trade, called portfolio margining. A lot of them have actually stopped doing that as well. Okay, and so that's kind of the case there in that also. So Fernando, that's what I would look to do with that. All right, Rajiv was thinking about doing a short straddle inside the married put a day before earnings, but later dropped the idea. Was doing it on Intel stock at 52, and you had a 55 strike put. Will be the best setup after earnings, which was very good, but stock is still down a little. If you think it's going to recover, I'd roll down the put maybe to take some of the cost off. All right, so your INTC position, TNTC. Oh boy. Let's try that again, shall we, folks? INTC. 152. Oopsies. And you've got some type of, I don't know what time it is. Did you say? No, it doesn't matter. Sorry, it's taking me so long, Rajiv, to get to your position. You've got the 55 strike for September. Oh, you did say September. Good, perfect. Okay, so just as the structure alone, this is what I've got with Intel. Now, as I mentioned, I thought about a short strangle, selling a call and selling a put against the married put position, but that is dangerous. Why? Because the put that you bought can now only either cover the stock, which is capped by a covered call, or the short put, which is not quite a naked put, but it can't protect both. So for short-term playing earnings, I want a good premium, and I think the stock's going to stay in a range, so I sell a 51 put, and let's say I sell a 54, the stock at 52, shorter term still. Well, now my risk goes up to just like a covered call. This is more like what's called a covered combination, where you have a covered call and a naked put against the stock position. One of the two, the stock or the put, is protected by the long put, but not both. It can only cover 100 shares of the stock or the obligation of that one short put. So if this tanked down to 47 or 48, you protected your stock with a 55 put, but now the short put is still losing 3, 4, 5 points. The put cannot protect both, so the risk goes up to 92.8%. Okay. Still a good profit, though. I see this, but that's what I didn't like. When you do the short strangle, you take the risk to the downside. So, you know, what is the best setup after earnings, which is still good, but it's down a little? Okay, well, we could take some profit off of this put, perhaps. You know, I might be able to, depending on what your outlook is. The stock's at 52.73. It's not bad. But I could sell that September 55, maybe roll down the 52.5. That only generates about $1.30, $1.40. Well, it's a trade-off. It generates $1.30 to lower your cost basis, but you're getting $2.50 less back, so your risk is going to increase drastically. Don't know if that's the best idea. You could hedge it by rolling it in, but again, now you've shortened the time frame for the stock to move up. With the positions here, I might consider that stock repair, honestly. You got the 52 and the 55 structure. You've got weekly options. Oops, sorry, folks. So I want to keep the 55 short. I might go 14 days out, but let me take a look here. Oh, that's nice. All right, so maybe I don't like it, but buying a 53.5 and selling a 55, but remember, do the 2-to-1. Don't know if this is going to get you what you want, but see, you generate a small credit here. Oh boy, I'm sorry. That's not what you want to do. Well, maybe it is, but that's not what I had it reversed. You're going to buy one of the lower, sell to the higher. Small net credit, okay, 12 cents. But see, now you've got this structured calendar, so if the stock moves up, it goes back in the next 14, 18 days to 54, 55. This is worth an additional 50 cents or $1. And this one here, I mean, you could say, well, why are you not just selling the 53.5? Because the put's at 55. The cost basis is too high to do that. Okay, so I don't want to sell a call below the put strike price in this scenario. That's why I'm waiting. Okay, so I would check out maybe the 5s or maybe the 6, right? The bear call spread in the structure there if you're not considering moving the put because you want more time. All right. Chuck had a question too. With VIX at 15 to 16, would credit spreads be better to the trade than the leap diagonal strategy? Depends on the outlook of the stock, Chuck. If you think long-term the markets are going to recover, and you're playing a position to not only gain capital on the long leap you're buying, but to lower it by selling short-term against it because you don't think the stock's going to hit those prices in the 14 to 20 day out, I'd say the diagonal strategy is better. Who knows, right? But that's what I'm looking for when I open a diagonal. It's something that I feel is going to be consistent growing long-term, and I can get good cost reduction in the short term. If you think now is a good time because you think the volatility is pulled back, things are settling down, and you think the next 7 to 14 to 20 days might stay in that range, then a credit spread might be good. But we're always stuck with that process is where the VIX is at 15 to 16 now. Someone could open their mouth on Thursday and say something bad. Something could happen with this Korean summit that comes out bad, even though they said they're doing a peace treaty and everything. But Wednesday they can say, nope, sorry, lied, here's some missiles for you. We're going to see the volatility go back up to 40, right? Bull put credit spreads will get slaughtered because the market will tank down. Bear call credit spreads would look good, but now buying back might be difficult because the implied volatility has shot up if you're not already past expiration. So it's a tricky game. But yes, volatility lower, more neutral to bullish, but bull put credit spreads, if I'm opening now, I'm still going far out of the money, looking for really strong probability up above the 85% range to stay out of that as well, okay? All right, Sam laughed when we were talking about MU. He says MU is actually rated or has a 98 target price by one of the guys there. Sam says, do you have Apple earnings trades? I don't. I'm waiting to buy after earnings calls or puts. Yeah, I don't have anything on Apple right now. Not for the same reason you do. It's coming out at 5.1. Yeah, I don't know if I'm going to do anything next week or not. I'll probably tell you too. But yeah, I don't have anything on that as well. Okay, as far as that goes. Yeah, and Sam does point out, I didn't look at it earlier. Sam does point out that the last time MU had earnings went almost up to 14. That might be a good play for an income method number 5 on MU. Selling the 15s and buying the 13 could work out really well if you can get the credit, but I didn't see a credit there as well on that position. Okay, AMD, yeah. Yeah, going back to that structure that I think I just removed there, the profit and loss chart, but when we were talking about the Intel position, when you do that covered combination, that short strangle, if you think that it's going to fall, I'm sorry, when you set up the short strangle, you're doing it to generate premium, Rajiv, of course, but you may get in the position where you're planning on buying more stock, of course. That's what Sam just mentioned. And I usually look at that too, is that you think you're planning on buying more shares of stock, averaging down your costs, and then you have to add another put to potentially protect it in that case. So that might be something that you want to consider because I don't know if you want to end up buying more of that at this time. When is it? Sam, now I'm going through I think I got through everyone's questions, and we've got, Sam, I'm rolling through your commentary here, and you had one that was actually a question that I missed. There's that one on EH. You went through the Verizon. You had calls at 50, closed at 51.40. 5 contracts was out of that. Verizon. You did AT&T, and then you did Verizon. I didn't catch that. Yeah, I should have paid attention to that the different structures and the earnings that are coming out between the two. The follow-up thought that looked like a question, and Verizon was up 3% today, said, when is a good setup for an entry in a stock or options to buy? If the stock closes for 5 days above its low qualifies, buy, maybe wait, replacement. Oh, okay, yeah. So Sam was just saying is that a good time for setup for an entry in a stock or options if the stock has closed for 5 days above its qualifier for buy, maybe wait for a retracement, I'm sorry, if there is one, okay? And follow the waves and the pattern. But what you said here is that in a short-term fractal, which confuses all traders and get them emotional to do panic size or panic buys. And that's one of the cases too, is that even if you're in these straddles or strangles that we were talking about, or even if you're playing the options in that situation and you see a movement, you don't necessarily want to jump right away on the position. perfect example. We can look. We're going to look at it real quick here. Oh, and Fernando mentions that your gain is in the change from euro to dollar, and that's tough because the put will protect you to where you cannot give back some of the more. But I don't really have a good solution for you on how you could protect the gain. You could just buy a put outright, and if it falls, that's that. But without doing some other different type of exchange values, I don't have a position. I don't have a strategy for you, Fernando, about doing some kind of spread or some kind of strategy on one of the ETFs that measures the euro to dollar change or anything like that to try to hedge a gain that you currently have between the change from euro to the US dollar. I don't. Not even going to try to talk my way through it. I just don't have one off the top of my head. But you might be able to take a look at that and find other positions. Sorry, the knee-jerk reaction. There's two of them here. Potley the other day, my cost was 30.01. I'm in it for 17 days. I have the 31 put. Well, the stock fell as low as 28.50, and then the other day, earnings came out and it gapped up to 30.50. And someone said, well, one of my customers at Fusion said, shouldn't you roll the position now that it's up? Because it jumped up, from 28 to $30.50. And I said, no, it's not where I want it to be. I need it to be above the put strike. I'm not going to overreact on this move. I'm going to wait. I said, well, you should maybe sell the 31 call for the position to at least hedge some of the risk. Well, after the earnings pop, you might want to wait, especially on a longer term play, because the stock went up to 31.20 today. It would have cost me double to buy back that call if I thought the stock was continuing up above 31, which I do, than what I originally got for it. So it would have added to the cost basis by reacting too soon. Sony was the one today, of course, and I had the income method number 12 in position to profit on both ways. And as we saw, the stock's down about 8-9% today, down about 450 from where it was. And as we looked at sort of Sam's day chart earlier, let's just take a look at the one-day chart today, and we'll use a 5-minute frequency. Now, if I got in at the exact perfect time, and that's what the customer wanted, right in the morning, it started to drop down, and that was good. But right here, 9:45, a customer sent me an email and said, hey, the thing's reacted. The thing's down. What's your adjustment? Well, no. No knee-jerk reaction. Let's wait. Now, what I should have done and what I'm probably going to do later, I would have done here. But shortly after that, it moved back up. Okay, so this was maybe my fault, but I said I don't want to have a knee-jerk reaction because I want to wait for things to settle down. I want this volatility to settle down. The Bollinger Band spike due to volatility from the yen, I want that to settle down so I can get some good prices. And I waited throughout the day, and then here it was back down to almost where it was, and then at the end of the day, it's back down to where it was. So these are the points I'm looking for. After things settle down, I don't want to try to panic in all of this and try to get filled on prices for a merry put. For Sam, if he was in this trade, if he had got in at the beginning at the first 10 minutes and bought the puts here, then he probably would have sold them here just before 10 a.m., right? And, maybe sold the puts here for a high profit, bought a call, gotten it, and maybe here. No, not there. I'm sorry. Here, probably would have sold the calls and bought another put, reversal. It could have done that way, all right? But I didn't want to this knee-jerk reaction because the prices were so out of whack and the bid-ask spreads were so wide. I would have spent this whole time fighting with the market maker to sell to close those two puts and try to buy another one. I'm going to get $10.20 back for selling those two puts, but then I've got to try to get the midpoint on the other. And here, it was better. And here, at the end of the day, it was better because there was no bid-ask spread. Instead of having a bid of 350 and an ask of 580 at this point, okay, we see midpoint's probably going to be, this 230 was there, so it would be 215. Oh, 115. I apologize. So 465. Where by this time, it was 445 by 475. Much easier to get 460. Here's about 430 to 455, I think. So I couldn't get the 465 for selling to close the two, but I'm still going to get a reasonable premium instead of hoping I get it here and 10 minutes later find out I can't even get that price. It's only worth $4. It's only worth $3.60. It's only worth $3.20. Now if I panic and sell here at $3.20, I missed out a whole lot of money. So I don't knee-jerk reaction in those scenarios. That's what I wait for. Okay, I wait to see it come down a little bit and settle. Oh yeah, I see what you're saying, Sam. This was just for the example of what happened this morning. And Sam says, you know, you need to look at daily charts and even 1 hour charts. They all got to be in the same direction, the 5 minutes to the 30-minute chart also. Yeah, I understand. This was just an example of the email I received this morning. It says, hey, why haven't you done anything yet? It says, because wait, let things calm down. And this is for a longer term trade. You know, this isn't the play. I didn't do a straddle play for earnings on S&E. Well, I did, and I got out here. On my earnings straddle, I got out here 1:40, 1:35 p.m. I didn't roll the put yet, but that was about the time I was going to, and I could have got a better price here. I'm holding it because on Monday, if the stock continues to go down, I'm going to be much happier. I'd love it if the stock fell to 42. I don't think it is, but I'd love it if it kept going down and over the next 3 days fell to 42. I have that ability because it's a married put with 2 puts to 100 shares of stock in it long term. All right, well, I think I got everyone's question. Randy says, thank you. Thank you for the work. Thank you for the education. He had to take off. Randy, thank you for your questions. I'm glad to see you here. As just mentioned, I think I got everyone's questions. I, of course, want to thank you all for your questions. We're a little bit past our normal time, but that's okay. And again, as I mentioned, we'll see how that turns out. This may end up being 2 different presentations because I accidentally clicked the stop button when I was trying to select my pen. And so we'll see, though. But in any case, remember, if you haven't done so yet, remember, go to powerop.com, just put in your name and email address. You can start a full 14-day free trial using the tools we showed today with the search for all strategies, the easy customization to find based on your criteria, using the portfolio to evaluate income methods as we saw with the married put, but those income method rollout opportunities are also there if you're tracking covered calls, credit spreads, diagonal spreads, straddles, and more. So you can take a full 14-day trial. Just put in your first name, last name, and email address and click Start My Trial Now. Our subscription levels to Power Options after your trial start at the $40 per month level for end-of-day data. We do, of course, offer a real-time service where every time you submit a search, you get the numbers and calculations at that very moment. And, of course, just the standard 20-minute delayed service at $60 per month. Again, if you want more free information, check out the blog, blog.powerop.com. We talked about the webinar that's available at powerop.com/webinars.asp. Under the options concepts section for manage a broken position, see ideas on that stock repair, ideas on managing down or other ways you might consider to manage a position that's down. We looked at MU today. Remember, you can always check us out on YouTube. I put up 2 fun things in the last 2 weeks. They're just quick 2-minute outlines, the 7 ways to manage your bear call credit spreads and the 7 ways to manage your bull puts. So those are kind of fun. You'll start seeing more of those. We call them the Swift Skills, 1 to 2 minute videos that outline a structure of a trade or management technique of a trade. It's a little bit teaser, but easier to digest to see some ideas there. So just some fun stuff that are going to pop up on YouTube and on different places as well. All right, so ladies and gentlemen, just remind everyone, if you think of any questions later on, send us an email at any time, support@powerop.com. Send questions to support@radioactivetrading.com as well. Remember, call us during market hours too, at 302-992-7971. If you're currently a trial member or a subscriber, you can schedule one of those coaching sessions at any time. It's essentially a 35 to 45-minute phone conversation with myself or with Ernie as well, okay? Oh, Rajiv says, can I get into a straddle on Monday and sell on Tuesday just before the close on Apple? Well, probably. I mean, yeah, you can definitely just open a straddle on Monday, buy a call and buy a put if that's what you want to do. The prices are going to be inflated because the whole market knows that that event's coming up, so you're going to see a lot of implied volatility, even if you go 3, 4, or 5 weeks out in time. Once the event happened, the volatility crush occurs. So you need the movement in the stock to be greater than the time value paid and the crush of implied volatility. That's the gamble with these straddles or strangles. But you can sell to close them at any time, you know, just like anything else. You'll be able to close it. If you bought it Monday at 3 p.m., earnings happen, you could probably get out of it Tuesday morning. But remember, depending on the movement of what happens to Apple after earnings, you're going to see wide bid-ask spreads. So in those first 20, 30, 40 minutes, just as we saw on the chart with SNE, Rajiv, you're going to be fighting the bid-ask spread to try to get out of a position. Sometimes it's better to wait. And if, you know, the stock gaps up, sometimes it's better to wait because you'll see a little bit pullback, and then it'll continue up through the day, so you might get better. but you're losing volatility fast, and you're losing time value fast. All that extrinsic value you paid into is decaying against you quickly. That's the danger with those. Okay, all right. So Mark says, thank you for the survey. You're welcome, straddles and strangles, Mark. If I come across any other good education I've got there, I'll point them in your direction as well. Sam's leaning towards a surprise with Apple to the upside, but we'll see what happens. FANG stocks have been doing well. Got to admit that. Sam also says, thank you very much for the nice session. Thanks for learning, and you're a great teacher and a star. Thank you, Sam. I appreciate that. I appreciate your questions and the emails I get from you and your feedback during the webinars. Everyone, Sam says, have a relaxing week and spend time with your loved ones. We look forward to seeing you next week. Thank you, Sam. We look forward to seeing you guys next week, too. Ladies and gentlemen, have a fantastic weekend. Relax. Enjoy the time. Heading into May in a couple of days. We'll see what happens there as well. We've got that the FANG ETF Sam mentions too. I've been trying to think about playing that too as something. I'm not sure what yet, but we'll see. And Rajiv, you say thanks for all the great teaching and coaching. Thank you, Rajiv, for your questions. I greatly appreciate it, though. Don't let me sugarcoat that. I appreciate your comments also. Take care, everyone. We'll see you soon. Good night.